right now we are going strong live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Property of the
Week.
I'm your host, Pablo Gonzalez. With me, as always, the man that we love to call GC because he's got genius concepts. He knows how to generate cash flow. He's a great co-host. And because his name is Gregg Cohen. Say hello, Gregg.
Hello, everyone. Great to be with you.
Gregg, I love when you are talking about the strength of your team and everything that the team is accomplishing. And you're talking about the Tuesday morning meetings. All that stuff is kind of like precursor to the show. Your culture is amazing. Like I don't want to, I wanted to kick off the show, but I also wanted to acknowledge what everybody is doing. And just you and your three partners as leaders have, from the moment that I met you, have struck me as different. So like, I just think it's extraordinary what you're all accomplishing and how much of a team culture you've built. I think it's really, really cool. I'm pumped to be a part of that team and to be able to add to whatever is happening and these world records that are setting and hopefully set another world record in 2022, man. So I just I wanted to do the intro, but I also want to acknowledge everything you shared. Thanks for sharing that with us, buddy.
Well, thank you. Thank you for that. Our team really cares, and our team cares about performing, and our team cares about getting better and challenging ourselves, and our team is strong, and it's fun to share this victory with our clients, with our community, and with our team. 2021 is certainly a banner year.
It's cool, man. And we're gonna share our community here and the things that we're doing. But as we like to say when we start this call, if you are looking to find out about owning rental properties in your investment portfolio, you're in the right place. If you are trying to find out about best property management practices for rental portfolio owners, you're in the right place. And if you're trying to get an edge on the Jacksonville market, because it's the hottest market in the United States, you're a real estate professional looking for opportunities, you're in the right place. Next place to go is chatwithjwb.com. Have a personalized treatment of what you're getting right now on the Not Your Average Investor Show. Before we do the roll call, because we are on the POT dubs, the JWB Rental Property of the Week. I want to encourage you to go to jwbinventory.com. You're going to get to download the property evaluation that we're about to fiddle with, so you can fiddle with it yourself and use it for all of your own investment needs. And now it is my favorite tradition that we have here, GC, is the roll call. Y'all, you ready?
Let's rock.
John Henning, good afternoon. Lee Bishop, great afternoon, my friends. Jen Filzen, fairy godmother of the Not Your Average Investor Show community. Good morning, JWB family. Dean Curry checking in from Columbus, Ohio. Chris Gonzaga from parts of New York that I'm not very familiar with, but I know it's New York, not New Jersey. Good day, everyone. Who do we got? We got Gina, our community manager. She's welcoming everybody here. So if you have a specific question you want Gina to help you with, she's just trying to add to the experience so that you feel welcome. You come back. We want you here hanging out with us. Carlos Andres Lopez. Hello, Cal from Lima, Peru. Carlos, I am planning a trip to Lima, Peru for a wedding on January 8th. I haven't been to a South American wedding in like 6 years. I can't wait to go. Hope to get to know you, buddy. Greg Stone, howdy from New Jersey. Who else we got? We already said Lee Bishop, who's our MVP of the Not Your Average Investor community. Leo, good morning from California. Who else we got in here? Ashmara Williams, first timer. Ashmara, welcome to the show. Hope that you make this a habit. Hang out with us from the west coast of Florida. Oh no, Ashmara W from Florida. Let us know where in Florida you're from, Ashmara, and if I'm pronouncing your name correctly, of course. I don't want to have another Hervé situation on our hands. Lydia Filzen, the mother of the godmother of the Not Your Average Investor Show community, closed property number 5 on Tuesday. She's back. Welcome, Lydia. Renowned author Lydia Filzen. Who else is here?
Future guest as well. She'll be on the show on the POT dubs here pretty soon. So we're keeping the seat warm for Lydia.
Future guest indeed. I can't wait. I can't wait to get there. Kyle is new with us. Carlos Andres, he's new to the show. Ken Moline, Not Your Average Investor Show celebrity. He's here. Hi, Jen. Looking forward to Sunday night. That's right. There is a meetup happening in Northern California. Stevie B in the house. Good afternoon, Stevie B. Good to have you back, buddy. Esteemed member of our Facebook group, Sergio Prieto. What's up, everybody? Go Gators, Sergio. I know that you're a fellow Gator. Scott Belote, also former Also not your average investor show celebrity who's been on the show, Bill Shields with his patented Buenas tardes, damas y caballeros. Good to have you, Bill Shields. We got Blog Guru in the house. Color me impressed, Blog Guru. I want to know about your blog. Welcome. I think that's a new name that I don't recognize. Raj Bantu is back. Welcome back, Raj. Hervé from The Jurors. He's back as well. Hello, Hervé. Good to have you. And that's it. That was a long-winded roll call. I know somewhere in there, Jen announced that she is having a meetup in the Northern California area, in kind of like that Bay Area, San Jose. Jen, maybe you can post it again in the chat. If you're there, if you're anywhere close to San Jose, Carmel, Monterey, San Francisco, Salinas, I can mention all sorts of little towns around there because I used to work in that area, but I won't. But if you're around, Jen's having a meetup up there. We'd love to everybody to hang out. We are a real community out here. If you're joining us on Facebook, give me a hashtag new or comment on there on Facebook. Would love to engage with you as well. Gina is on both sides of the equation. But if you want to ask questions, this is an interactive show. We encourage it. The chat is already blowing up. Everybody making friends. Just make sure that when you're chatting in the chat, you change to everyone. It's defaulted to host and panelists. So you're only talking to us. Ashmata, thank you very much. Pronounced perfectly. Working land and houses in Jacksonville. All right. So you're right down the street here. Ashmata, just so you know, you're only chatting to me and Greg, right? So like if you change to everyone, everybody gets to see it in the chat. And last but not least, if you want your question asked on the show, pop open that. There you go. You got it. Pop open that Q&A box. And that is the stuff that I'm going to ask GC here. Contextual. You can ask anything. We encourage questions early and often. Start popping them in because we love to break it down for you as we are analyzing this property. This is about education. This is about you understanding how this stuff fits into your portfolio before you take that next step to chat with JWB.com. Man, that was a mouthful, Greg. How you doing, buddy?
As the show grows and grows, it's going to be tough to fit the roll call in here, man.
You know, if we have a 45-minute roll call, I think my life is complete. That's really, right. That's really where I want to get. Cause this is what I like. I like the Thursday show. I like just us hanging out with our friends, talking real estate, talking self-improvement, talking retirement and passive income and stuff like that. So I'm super, super into it. GC, you were just giving us some updated numbers from JWB before we gave live. And then I just kind of gave you a compliment about it. You want to give us just a quick cliff notes again for anybody that just joined us, because we got at least another 15 people on that weren't here before.
Yeah, it's been so I'm coming out of quarterly manager meetings at JWB. We sit down with all of the supervisors, managers, directors in JWB every quarter, and we talk about each department. We talk about the wins, the struggles, and we talk about the people that are delivering all of our products, services, and taking care of all of our clients and our residents. And so these discussions are amazing. From that discussion, we see how we're doing quarter over quarter, how are we doing trending, right? How are we doing compared to business plan? So coming out of that discussion, I thought it was really great to share some incredible wins as far as production within the JWB engine. And one of the coolest things being a vertically integrated provider, you know, we control all aspects of the investment for our clients out there. So we're there buying properties, we're building or renovating properties, right? We are filling residents into homes, that's leasing, we're doing property management, we're focusing on renewals, we're selling properties to you all as income streams. And so all of these metrics are what we share. And we share this with our team as well. We actually sit down every Tuesday in a Tuesday morning meeting, and we go over our numbers of for each department. What are we predicting we're going to do this week? What did we do last week? So everybody's just full transparency, and we sit down and we share these numbers. So I want to share some of the highlights with you. I'll go through them really quickly here. Acquisitions, new world record for us in terms of buying properties. We have bought 735 properties at last count. There's probably a few more since then, but that's a new JWB world record in 1 year. We had never done that before. So that's a new world record, and that's through the end of September there. So big accomplishment. In order to do that, we have to raise debt. We have to raise private money. Many of you listening on the call are private money lenders to JWB. We thank you. Those dollars go to building the houses that then become the cash flowing assets. We've raised to date $22 million in private lending funds, which is an incredible accomplishment for our team. It keeps the engine running. Lease renewals, 860 lease renewals, well ahead of our target goal of 70% of leases expiring, getting renewed. We're well ahead. So 860 lease renewals. That's an incredible reduction of maintenance and vacancy and property management fees to you as an owner to the tune of $5,000 to $6,000 every time we renew a lease. That saves you $5,000 to $6,000 on average. And then sales is crushing it. This is the time to be in Florida real estate and rental properties. We're happy to be where we are, and you all have significant demand for this type of an asset. So we are well ahead of business plan. We plan to sell about 460 houses this year. Through September, we closed 437, which is incredible. Still have a quarter to go. So we're excited about that. And big shout out to just the relationships that we have with our clients. Out of those 437 sales, 257 have come from repeat sales and referrals. So working with all of you to fulfill your buying plans is the overwhelming majority of where our sales come from, and we want it to be that way. That is a sign that you all are loving our product and our service and our people. And so, I'm really proud. I'm really proud of what we're putting forth into the world as far as the wealth creation that we're a part of. And I'm proud of the relationships that we have, and it's showing up in the numbers.
I'm proud of it too, man. You know what's funny to me is that if you're not well versed in the world of JWB, you may not know that you guys have been written about on the front page of the Wall Street Journal more than once. And when you are talking about setting world records, it sounds like this superfluous thing that you guys are just calling it internal world records, but it's very likely these numbers that you're reporting that are your best numbers ever really are world records, because there's just not really other vertically integrated turnkey rental property providers out there in the world.
Well, I think, I don't know if that's a world record, but I think if you take it through the lens of a vertically integrated operator in one market doing this type of activity, you just don't find any other JWBs across the country. You might find some operation that go national, and they try to do this on a national scale, and their numbers will be bigger, of course. And our approach is to be hyper-focused on the Jacksonville market because we think that it delivers the best risk-adjusted returns for clients. So I think if you took that lens on it, yeah, you'd find a lot of world records because a lot of people have a different approach than we do. Yeah,
you're a category of one, man. So I think it's really, really cool. And now, people are real impressed with these numbers. They're here they love the macro stuff, but what they've come is for just some raw education on property numbers. And let's look at a property right now. Therefore, we are going to jwbinventory.com. We're downloading the sheet, and surely you're going to love this property this week because we are magically whisking you away to 4747 Shirley Avenue, Jacksonville, Florida, 32210, purchase price of $200,000. It is a 3-bedroom, 2-bathroom home. Let me know in the chat if you can see it okay, if I got to fiddle with this stuff. By the way, Marilyn Cotterman in the house from Homosassa, Florida.
Home of the manatee. Sorry about that. I was a little late.
Yeah, a little late. It's okay. Marilyn was a little late too. So
zoom in a little bit on the numbers when you're going through it because it is a little blurry.
All right. Going to zoom in on the numbers here. So $200,000, 3-bedroom, 2-bathroom home. It's got a driveway. It's going to be rented out at around $1,285 a month. And then the numbers you see here, here's a picture of it. You see the numbers here that we're actually, as investors, most interested in is this estimated conventional financing total monthly cash flow of $160 and this total ROI of 7.01%. But before we get into these numbers, GC, what do you love about this property, man? What made you want to pick it for the POT dub?
I'm always thinking about what can be an opportunity to teach or help those who are maybe new investors or not familiar with the Jacksonville market or not familiar with JWB. So I'm always looking for something that I can point out that is a reason that this property is, of course, the property of the week for me. For this property for this week, the fact that it's a renovated property is one that I wanted to point out. For those fans of the show, you haven't seen a lot of renovated properties lately. Shouldn't be any surprise, right? The dynamics of the market right now are that prices are going up, which makes it harder to find existing inventory to be able to purchase, renovate, and still make the numbers work for all of you. So renovated homes are fewer and farther between, but we love them when we have them. And so this is, of course, a renovated home that meets our criteria. But the reason why I love this home the most for you is because it is renovated. That means that you can actually purchase this property and close on it in a much quicker fashion. Now, we love building new construction homes. Of course, we talk about that a lot. But one of the drawbacks of a new construction home is that you put it under contract today, and then it'll actually be done about 3 or 4 months later. So you can't actually close on the house for 3 or 4 months, right? With a renovated home, the home is already under renovations and you don't have to wait nearly that long. In fact, I looked up the estimated date of completion for this home here on Shirley, and this home is estimated to be completed by our construction team at the end of this month. So what that means for you is that you can actually put this house under contract. You can immediately start to lock in your loan, lock in your interest rate, and work towards that closing in an aggressive manner, right? You can get to the closing table. There's nothing holding you back other than your documentation, because this home will be ready to close in a few weeks from JWB's perspective. So that really means a big deal. If anybody has tried to buy a property right now, generally you do have to wait 9 months, sometimes 12 months when you're out there trying to buy a property, either because you can't get one accepted or because you're buying a new construction house, but it takes that long to actually build the house for others. For JWB, it's not that long, it's 3 to 4 months, but that's still a long time. Like for a new construction home, you're going to put it under contract, even with JWB, and we're going to tell you, don't go ahead and lock in your interest rate on your loan yet, because you only want to do that maybe 30 or maybe 60 days before the loan is actually going to close. So you don't have to do any of that hurry up and wait when it's a renovated home. As I mentioned, these are fewer and farther between, but if there's one thing to point out for this home as to why I love it, it's simply, it meets all of our criteria. We love renovated homes, and then you could buy it as early as the construction is done, which is probably at the end of this month.
Love it. We're going to talk about this criteria right now. But first, I just want to say, when you say you can buy one of these homes, you mean you can buy one of these homes. Dean just put here in the chat that he just put under contract a couple properties that were on the property of the week a couple weeks ago. It's the townhomes that we talked about in McGurk's.
Oh, no way. Congratulations, Dean. Was that when Brandon was on the show?
Yeah, that's right. That was the Brandon show when you were playing golf. Oh, not great. Playing golf. We're out here slinging out townhomes. No big deal.
Dean, that's so cool. That is so cool that you show up every single week, such a big part of the community. And, you know, I want you to see these assets for what they are. When we point them out here, that these like when I point out that this is the property of the week, I want you to know there's a lot of thought and care that goes into it, right? We prepare sometimes weeks in advance before we do it. So I love that you listen, you take advantage of this opportunity, and then you put one under contract. It's amazing. So congratulations.
I'm with you, Dean. I picked up a property of the week myself at 7171 Lucky. And GC, as long as I've known you, I feel like you put a lot of love and care into everything you do, buddy. It's one of my favorite things about you. All right, let's talk about the numbers on this. You know what? We promised that we'd go straight into Q&A if there was Q&A, and there is, right? So Sergio Prieto asks, are future increases in escrow accounted for in the total ROI? Is that maybe a question he's talking about when you talked about new construction and having it come down the pike, or?
Well, Sergio, I'd ask you to clarify a little bit more what type of escrow you're thinking about. I'm thinking that he's thinking about the escrow as far as what your lender escrows for you. So I'm going to take that approach, because this is something that can actually, there's a lot of misconceptions about it, can actually, if you don't understand why certain things happen with the escrow amount that your lender escrows, it can create a poor experience for you. So what can happen is your lender sometimes escrows too little for taxes and insurance in a year. And when that happens, your mortgage payment is lower for that year, right? Because your mortgage payment is your principal, your interest, and your taxes and your insurance. So when your lender escrows the taxes and insurance for you, that's how it's, of course, comprised. Well, sometimes lenders, and we have no impact on this. We can't control this. It's a lender who makes this decision. Sometimes they under escrow, which in the year that it happens, that's more cash flow for you, right? That is more cash flow in your pocket. So we love all that. The problem is if they under escrow it, that means that the next year they're going to swing the other direction and they're going to escrow more to make up for the shortfall. So it can create a cash flow crunch. Now, at the end of the day, everything that we laid out here on the evaluation is still playing out over that 2-year span. But sometimes this can happen to clients and they can say, hey, JWB, what happened to my cash flow? And so we do an analysis with them. We sit down, we look at the escrows and we say, okay, well, they underfunded your escrows last year. There's no amount of data that we can give them. Unfortunately, banks don't use my property of the week evaluation like they should. They make mistakes and they underfund it. And then the next year it can feel like your taxes, your insurance, your overall mortgage payment has gone up substantially, when in reality, they're just making up for that shortfall. So hopefully that, Sergio, is what you were getting at, gives you a little bit of insight into something that can be a pain point for you as a rental property investor.
Yeah, he clarified here in the chat, county taxes on one of my properties are increasing. And then he said, thanks. So
yeah. So, and Sergio, reach out to the portfolio manager, to your portfolio manager. If you have any questions about that, I'd be happy to go through and just align what your escrows were to the evaluation and make sure that you're in a good spot there.
All right. And Jen is saying in the chat, Florida taxes still way cheaper than California taxes and Texas taxes. One of the things
that is
like
true.
That
is true. We love that. We don't mention that nearly enough.
Right. Especially it's Texas guys. All right. You ready, buddy? Let's talk about these numbers, man. Tell me about this estimated conventional financing total monthly cash flow of $160. What does that represent?
So to me, total monthly cash flow is one of the great separators of this asset class versus the other asset classes, the more traditional asset classes out there, stocks, bonds, mutual funds, right? Stocks, bonds, mutual funds. You don't get a dividend every single month that's worth much. If you do get a dividend, right? You don't get much. Most of the time you don't get a dividend. If you do, it's not worth much. But in rental properties, you actually have an asset that pays you over and above what the costs are every single month. So you get this kind of this dividend check. And to me, what this represents every single month is risk mitigation. And the reason that this is so important to me is that I've lived how important it is to be investing in positive cash flow and to put your money in assets that pay for themselves every single month. For many of you who know my story, I started in 2006 with my business partners, and I was very young, definitely very young in real estate, and didn't know a lot about how the market worked when I went out and I bought 40 rental properties with debt on them. But the one thing that I learned early on from my mentors and from reading and from talking to those who are much more successful than me is the power of positive cash flow. And that power of positive cash flow helped me because I started to invest in 2006. I owned those 40 rental properties. Some of them had high interest debt on them. And I lived through the crash. And I lived through the Great Recession when values dropped 35% in Jacksonville and across the country. And the fact that my cash flow, my assets paid for themselves every single month meant that I didn't have to sell them. It mitigated my risk because I invested in assets that pay for themselves. They brought in money to me every single month, no matter what the home value was. I still produced that $100 a door, $200 a door in positive monthly cash flow. And that above all else is the reason why I continued to own those properties, those 40 rental properties. I still own them. And that number has grown to over 300. It's that risk mitigation that comes with positive cash flow. And you get it in this asset class when you invest in a market like Jacksonville with a great property manager like JWB. And you don't get that in other asset classes. So when you see total monthly cash flow, think risk mitigation, right? Risk mitigation. It's paying you every single month. That $160 is not going to change your life. You buy one rental house and you get $160 a month in positive cash flow. Newsflash, it's not going to change your life. But what that does is it mitigates your risk. And that's only one of 5 profit centers. And it allows you to become scalable, to add more properties to your portfolio so that you can take advantage of all 5 profit centers, which is the real win in rental properties. People get it confused. They think cash flow is the end all be all in rental properties. Cash flow is like the entrance to the dance. Positive cash flow is your entrance to the dance. All 5 profit centers is how you profit the most over a full real estate cycle.
Entrance to the dance, quarterback arm strength in the NFL. We can dice it a couple different ways that we'd love to do it on the show. But like you said, right, it's all about risk mitigation. The idea that as long as it's positively cash flowing, this now makes this a pleasant experience moving forward so that you can benefit from the 5 profit centers. And then this 160, right? That's the typical kind of monthly experience, right? It doesn't include one-time cost. This is what most of the months of owning this property is going to feel like, because it's a pretty direct monthly kind of like cost minus expenses of the monthly cost, right? So talk to me about this total ROI 7.01%. Now that you alluded to the 5 profit centers.
Yes. So the total return on investment is how hard is your money working for you, right? You can have positive monthly cash flow, but a low return on your investment. And that's not great, right? We need to have both of these things working in our favor here. We need to make sure that there's risk mitigation, and then we need to have an opportunity to earn above average returns on investment. And total return on investment, of course, takes into account how hard your money is working for you. So here is where we take all of the good things and all of the bad things that come along with rental properties, and we objectively measure this return on investment. And then you can compare this to other asset classes. You can compare this to other real estate markets. This is your apples to apples comparison, right? Specifically for total return on investment, we're going to take into account your net rental income, which is that positive cash flow I was just talking about. We're also going to take into account your tax savings. These are tax advantages that are available to you because you own rental properties, and they're available to everybody who's watching the show. You don't have to have a certain license. You don't have to work in real estate to take advantage of these. You get incredible write-offs for owning rental properties. And so those tax advantages result in real amounts of dollars that you don't have to spend every single month, every single year on taxes. You keep that money. That's a real return for you in your pocket there. It also takes into account principal pay down. One of the most beautiful experiences, and I've experienced this now because I've owned these rental properties for over 15 years, is waking up, looking at your loan balance on a property you own and realizing that it is significantly lower or paid off. And who paid that off? It was your resident that paid that off for you because they pay the rent to you. A part of the rent is positive cash flow, and a part of the rent goes to paying all the other expenses, which includes your loan. And a part of that loan that they're paying for you is your principal balance. They're reducing the loan amount for you. And it is something that's truly incredible, especially after you own a rental property for a full market cycle, which is known to be between 10 to 20 years. So that's a real return every single month. It might be $100 or $200, depending on your loan, that is dropped because your resident's paying that for you. It's another profit center. So we take all of those, and then we also take the negative items that are going to happen, like maintenance cost and vacancy cost and tenant placement fees. Those are real costs that happen every once in a while. They don't happen every single month, but they happen every once in a while. And so we take all of those costs into account. We take into account closing costs, which is important. Whenever you buy the property, we need to make sure we account for that. And we take all the good things and we divide that by the bad things, and we wind up with our return on investment. And we take all the good things, we minus out all of the bad things, and then we divide that by our total initial investment. Sorry about that. I've only done this about 1 billion times. So you take the good things minus the bad things like maintenance, vacancy, and tenant placement. You divide it by your initial investment, and that's how you get your overall total return on investment. And that's how we get to that roughly 7% number there.
There you go. So holistic picture of how the investment performs. Let me do something. I'm hearing some kind of feedback on some, do you hear some kind of like audio feedback?
A little bit, just now.
I don't know where that's coming from. All right. Well, I think it's gone now. So total holistic picture of the investment at 7.01%. You mentioned a couple of things that I like to hit on. Number one is what Tim Hicks talked about, where it's kind of like a beautiful part of rental property investing, which is that as long as you got that monthly cash flow going on, you're in positive, worst comes to worst, your resident is paying down your debt, right? So like, that's like this like automatic take it to the bank return. And what that means, what I've learned that means is that this 160 at some point, very, very naturally turns into this 876, right? So like what you're getting in at first is this positive monthly cash flow when you finance, but after some time, this is what your properties are spitting out monthly, which is why it's so significant for retirement, especially if you're, got retirement coming down the pike in like 25, 30 years or whatever, getting a little army of $800 a month is a really, really sweet spot to be in. You didn't mention 2 of the profit centers and how they play in. One of them is appreciation rate. We have it here at 0%. But before we get there, I'd love to dive into some of the Q&A since we have it rolling, and I like to be a man of my word here. So Lee Bishop asks, this property has a fireplace. Does that mean that the insurance is going to be a little higher because of that feature?
I don't think fireplaces lead to higher insurance costs. I could be wrong on that. I haven't asked that question in a while. I would say overall for renovated homes, you're going to experience higher insurance costs than you would for new construction homes. And so if we go over to the left there, Pablo, we can kind of see this playing in action here. All right, well, I won't wait for that. There we go. Yeah, so you see row 27 there, $938 for homeowners insurance. That's a little bit higher than what you'll see for a new construction home. All right, that should make sense, right? For new construction homes, the building codes have been improved. Insurance companies have run the analysis, and that new construction homes experience less loss than older homes do by and large. And so their insurance premiums for new construction homes are lower than renovated homes. So this is right in line with what a normal renovated homeowner's insurance cost would be. And so, so I don't see anything different there. And if anybody's more of an insurance expert than me, feel free to chime in if chimneys, affect that. I don't think they do, but what I would do is I would recommend you reach out to your insurance expert. And if you're a member of JWB's team, you can reach out to our team, the JWB portfolio manager, who's there to take care of everything for you, and we can get that answer. Or you're probably referred to the Ritchie Insurance Group, who we love and does the majority of our insurance business. And so I would encourage you to reach out to them as well. They're a great partner.
Awesome. Carlos Andres Lopez, first timer here. Happy to have you, Carlos Andres, asks, why is the vacancy rate 4%? Is it going up?
Well, all of these vacancy and maintenance percentages here are all based on the data that we have. And so one of the things that we do is we look at the data to be able to put forth our expected maintenance and vacancy costs. That's very different than what other providers do across the country. Many providers just use industry standards that really don't have any data to support their perspective. And that's what they do. And they put really low numbers out there. And unfortunately, if you don't have data to support your numbers, and you put too low of numbers, you can create a poor experience for a client. You can create an experience where you tell them that returns are going to be 7%, but you really didn't have a chance of performing at 7% because your maintenance costs, your vacancy costs were so high. So JWB does the opposite. We actually look at the data. That's where we get all of our vacancy and maintenance costs. We typically analyze this on an annual basis. And this data, of course, comes on these spreadsheets. One of the things that we do, though, is we break it down by something that may be very impactful for the data. We dissect the data because we can do that. We've seen new construction homes perform slightly differently than renovated homes. So new construction has maintenance cost of 4% and vacancy cost of 3%. For renovated homes, it's 4% on the vacancy side and 9% if this is a septic property, which this one is. It's a little bit less if it is if it's on city sewer. So we're always looking at this holistically. Then we're looking at the asset that we put in front of you. We've got data to support it. And that's how we set the right expectations for you coming in. And if we compare renovated homes and new construction homes, the thing to take into account is that there's advantages and disadvantages to both in terms of return on investment, right? At the end of the day, you're going to be between 6 to 8% returns, not including home price appreciation for renovated homes and new construction homes, which is exactly where we are here. But the way that you get there is a little bit different. For a renovated home, your purchase prices are going to be lower, right? $200,000 is on the lower side of purchase prices right now, right? Your property taxes are also going to be a little bit lower than a new construction home, right? But what you'll also find, but your insurance costs, as we talked about, are going to be a little bit higher. So you give a little bit back there. You're going to see that your maintenance rates and your vacancy rates are a little bit higher as well, slightly, right? So those sort of offset and they get back to this magical number of 6 to 8% returns. And for those who follow the show and show up every Thursday, you see a lot of new construction homes as well. And guess what? Those returns on investment are 6 to 8%, but the opposites apply, right? Purchase prices are higher, right? Property taxes are higher, insurance costs are lower, maintenance and vacancy are slightly lower. And that's how we end up in the same spot. So we love them both. It's just get there a little bit differently.
I think that's a really good explanation. I like that it was piggybacked on the insurance conversation, right? Because at the end of the day, I think the big takeaway from your response to both of them is these are real numbers because you're quoting the insurance before you give them the property because you have the in-house teammate that is doing all of it. And you're basing your vacancy and your maintenance rate based on 4,000 data points, all that are within the same ecosystem with the same contractors, with the same standards, all the stuff. So it's the data flywheel that we like to talk about. So all of these assumptions around it are real numbers. And what really matters is that you see this and this, right? That you see the positive cash flow happening and to see the total ROI percentage being of the same type that you normally offer. And if you haven't been on a lot of shows, we've been on a lot of new construction properties. So these numbers were a little bit different here and the price point was a little bit different, right? It's a little higher, but these numbers were always constant. And now that we are showing this renovated property, again, we're back to the constant of return and cash flow, but it's fed through other assumptions. But what matters is that you're getting these returns and that they're real.
Nailed it.
All right. I woke up, I had a little extra coffee this morning. All right.
Mm-hmm.
Lee Bishop asks, I see this house is also on septic, but is it going to have the new pricing for septic insurance paid by the tenant?
Yes. So, Lee, great question here. So one of the most exciting things that we rolled out this year has been our septic warranty program. And the septic warranty program really is a game changer as far as reducing maintenance costs for septic properties, right? One of the biggest maintenance items that you could see if you own a property that is on septic is your septic tank goes out and the drain field goes out and you need to replace it. I mean, that's a big expense. And so when we're looking at ways that we can reduce maintenance costs, we always look at the biggest items and how can we come up with a system or people or talent or whatever the solution is to reduce that. Well, we came up with a septic warranty program, and this is just a huge win. It's a huge win for everyone. For any new septic tank that is put in, whether it's a renovated home or it is a brand new construction home, for any new septic tank, the septic tank is under warranty. That means if there is a major fault in the system, then you are not on the hook to replace that unit. The cost is not coming to you. And who pays for this? The resident actually pays for the warranty. And at first, you may be thinking, wow, why would the resident pay for the septic warranty? But if you think about it, residents pay typical utilities for city water and sewer. When it is on city sewer, right, a part of the utility bill is to go and pay for utilities, right? Now, that same type of expense is what the resident will bear, except when it's on a septic tank, that utility cost that would go to city sewer if it was on sewer now goes to the warranty program for your septic warranty. And so at the end of the day, it's the same experience for a resident, whether they were on septic or sewer. It's the same money out of their pocket, roughly. And so we haven't burdened them in an additional fashion. And for you, it's a huge reduction of risk. And so, the only thing is I haven't confirmed whether or not a brand new septic tank was put in on Shirley. That would be the only caveat that I can give you on this one. I didn't do that research ahead of time. So if somebody is interested in this home on Shirley Avenue, feel free to reach out to my team and feel free to ask that question to see if this home is covered by the septic warranty program. If it's a brand new system, it is. If it's not a brand new system, it's not. So I don't know that information, but that's how the septic warranty program works in general.
Sweet. That was first introduced when we had Melissa Gillespie on, and we had her report on like the JWB employee ideation day, where everybody got together, thought about how can we do things better, right? Like you shut down the company for like a half a day or something like that. And everybody just showed up with ideas and then broke out into pods. And this was one of the ideas that rose to the top, right? I'm fascinated by that. So just wanted to let everybody know where that came from.
Absolutely. Wasn't the first time, won't be the last time. Great ideas come from within for sure.
Love it. Love it. All right. Carlos Andres is showing his chops as a savvy investor over here because he has another question. Non-recourse financing at 7.75%. Question mark. Announced last week was dropping 1%. That was it. But I mean, I'm sure he's saying, hey man, what's going on here?
Yeah. So that is absolutely true, right? Recently, we have been able to secure our non-recourse partner at a lower interest rate for non-recourse financing. And so this is going to significantly increase your cash flow, and there's no downside to it. We love it, right? The terms are better. I don't remember exactly how long the terms go out to, but it was longer than what it was before. And I don't know if it's been updated on this evaluation. Sometimes we're a little bit slower to roll it out for evaluations that have already been created, and we just talk about it in terms of the conversation with the client who's interested. Of course, something that would be a benefit for you is it's always nice to find that out after you're already interested in it. So let's zoom in there. But yeah, so the interest rate is 6.75%. It's 30 years. Dean Curry, he knows, right? So 30 years at 6.75%. There we go. So for this one, for non-recourse, which is if you're buying the property in your retirement account, you can, and Lee, thank you so much for the information, right? So not only did the interest rate drop from 7.75% to 6.75%, but the down payment has also, the requirements already dropped from 50% down to 40%. And the years has increased from 20 to 30 years. So let's go ahead and fire those new numbers in there and see how this thing kicks out.
All right. So I'm going to, by the way, this is why we encourage you to go to jwbinventory.com to download the sheet, because you can call us on our sheets. All right. So down payment is 40%. Okay. And this is us fiddling real time, and 6.75% here. Mm-hmm. Right. So that was in the non-recourse tab. So now do I go back to the summary now, GC?
Change mortgage from 20 to 30.
From 20 to 30. All right. Yeah. Thank you, sir. Look at all these variables we can mess with here. Mm-hmm. Okay. And now we come back to the summary tab, right?
You can do that. Yeah, it works. Or you can go to the right, either one.
Okay. Well, I'm back in the summary tab. Is that right? This now is 0.25% negative?
Yeah. Yeah. So for non-recourse, you're going to be right around break even, right? So now again, let's go back to why we're buying a property in our retirement account. Very different than why we're buying a property in our non-retirement account, right? Conventionally financed properties are what you see for that 7% return on investment near the bottom with $160 a month in cash flow. Non-recourse products are there so that you can buy properties in your retirement account, right? In your retirement account, you want to be able to diversify your assets. Most people are only investing in stocks and bonds and mutual funds in their retirement accounts, and they're looking for a way to diversify their assets. So being able to buy real estate in your retirement account is a benefit. It's a risk mitigation strategy, simply so you don't have all of your eggs in one basket there. So there's a benefit there. But the next thing, the reason why even me, who is a big proponent of positive cash flow, right? In retirement accounts, the fact that it's break even is really where you need to be, so much more than if you're outside of your retirement account. Because if you make an additional $100 a month or $200, $300 a month in your retirement accounts, right? You can't even use that. You're not using that cash flow for anything. It's hard even to place that additional $100, $200, $300 a month into other assets, right? Especially if you've got this in a self-directed account. And you're not going to touch that money. You're not going to put it into your own bank account until you're past 59 and a half, most likely, right? So the lack of additional positive cash flow really doesn't bother me in a retirement account, right? Break even is really kind of where you are. If you can get a little bit more, that's great, but break even is a great deal. Now, the thing to keep in mind in addition to that is that whenever you go into buying a rental property in your retirement account, you need to make sure that you're set up for success from a reserves perspective. And my team sits down with all of our clients well in advance before we ever select properties. And we make sure if you're buying a property in your retirement account, that you have enough reserves, because we know that these properties are going to be roughly break even. And if you are buying multiple properties and something happens, right, they're going to be break even largely like over the years, right? But at sometimes you are going to have a big maintenance expense at some point. Well, you can't tip into your regular personal bank account in order to pay it. You need to make sure that all of that money is set aside in reserves in that retirement account, bank account, right? So everything is there. So you just need to make sure you have enough reserves, which we prepare you for and the lender prepares you for. And then buying assets that pay for themselves every single month, especially in non-recourse, just break even to win.
I got to be honest, man. when I started hearing that it's at a lower, they're lending on a lower rate in a longer term, and you can only put 40% down, I thought that this was going to be like an under promise, over deliver moment where this thing would jump up. Why does the ROI go down a point? Like why does it go down to break even when all of a sudden the terms became so favorable? Can you explain the math on that?
Definitely. I love that you're pointing this out. So the difference is that you're only putting 40% down. So you have 60% now is the loan size. So your loan balance is much higher, which is the biggest reason why your cash flows have not dramatically increased. Now, if we're thinking total return on investment, when you have an asset that you only put 40% down, that is appreciating at roughly 4.3% per year, your overall return on investment from doing it this way will be higher after a full market cycle because you put less of your own money down. So you're giving up some cash flow today, and that's okay because you need it to be break even in an effort to make sure that you're profiting from all 5 profit centers, and putting 40% down versus 50% down with an asset that grows will result in a higher return on investment. Am I making sense there?
Yeah. Okay. That makes a lot of sense.
You can even, let's just mess around with it. Let's go back to the non-recourse tab and let's put 50% down instead of 40%. And yeah, you should see an increase there.
Oh, there you go. Now it's back up. Cool. So it pops up again, and cash flow goes up, ROI goes up, still around break even, right? Still not 1% isn't getting anybody out of bed, right? I feel like this is a good moment. Let's go back to that 40%. And I think this is a good moment to talk about that profit center that we haven't talked about yet, right? Yeah. Because at the end of the day, you're talking about non-recourse lending and investing in your retirement account. You're not getting it in cash flow. You're not getting it in the other profit centers. You're going to get it from appreciation rate. So why don't you talk us through the reason why appreciation rate's at 0%, and then let's show people how to estimate appreciation rate into their return.
Absolutely. Well, let's do it in the context of outside of your retirement account, because that's usually how we're speaking of this asset. That's where most of you are buying your properties anyways, outside of your retirement account. So let's do it there, right? The first reason why we have 0% appreciation there, even though Jacksonville is a growth market and it appreciates at a rate that is faster than the national average and faster and more than other comparable cash flow markets. Even though that's the case, we still put 0% here for our evaluations. Number one, it's because one of our core values is under promise and over deliver. And when it comes to investing in a full market cycle, I want to make sure that we have a lot of outs to make sure that when we control your asset for you, we can at some point down the line, 10, 20 years after owning the property, maybe longer, give that money back to you, right? Help you sell that asset, or however you're going to refinance or whatever. I want to make sure we've got a lot of outs to make sure that we can overperform. And by putting 0% there, that is one way that I know I'm being extremely conservative when it comes to this evaluation. That's going to set you up for success and our team up for success long-term to make sure that we can over deliver in terms of your return on investment. That's number one. It's one of our core values, under promise and over deliver. The next thing is that, flat out, investors don't know how to evaluate home price appreciation. And many times they think about it the wrong way. At the end of the day, home values don't always go up like people thought from 2001 to 2006. And you can't take the approach that home values never go up, that you're not going to count on it at all, which is really kind of the space that we live in today for most investors. They say, oh, geez, I'm only going to focus on cash flow. I'm not going to focus on home price appreciation because I can't count on it. Neither of those is the right way to evaluate home price appreciation. The right way to do it is to make sure that, and Pablo, I think you jumped off here. Is it only me now? All right. Well, I'll just take the show. If anybody has any questions, I'm now the moderator. I'm the new and improved Pablo. So fire him in there and we'll get him to you. We'll get to him. But now the right approach is this balanced approach, understanding that if you give a real estate market enough time, it will be cyclical and home price appreciation will repeat itself. And we have data to support this. cycles repeat themselves. Home price appreciation rates in your local market tend to repeat themselves if you give it enough time. And a full market cycle is 10 to 20 years. So the reason why I have 0% there as the appreciation rate is because I don't know how long you are going to be invested in this property. I hope you listen to me. I hope you do as I do, and most of our clients do, which is to buy and hold for a full market cycle. That's how you'll get the best return on investment, because now you can count on home price appreciation. But I don't know if you're going to do that. And until I know that, I'm not going to put this in the evaluation. And then when our team sits down with you and we go through, is this the right investment property for you? We're going to run those numbers. We're going to look at it if appreciation happens, if it doesn't. So it gives us an opportunity to be able to include that if you are buying and holding for the long haul. And then the last point, the reason why I don't include it right off the bat is, being able to produce a return on investment absent of appreciation, a return on investment in the 6 to 8% return range that produces monthly cash flow for you, positive monthly cash flow, that dividend, which is probably better than you can get in the stock market. That investment by itself stands on its own 2 feet, right? We don't have to go to every length, every degree to go out and throw all of the best things ever into this investment to be able to have clients get excited about it. The stock market typically produces somewhere around 7, 8%, maybe 9% returns historically, but you got to deal with a lot of volatility to get there over the years, and you don't get monthly cash flow typically from it. So if you have that same type of investment in rental properties and you do get monthly cash flow and it's a lot more consistent, then there's no reason to put all of the big shiny objects out there in our evaluation. So that's really how we do it. And I think it's a one-man show right now. We love technology, and it looks like it came back to bite Pablo here. So I'm just going to take the reins and look at the questions that you guys are firing in here, and we're gonna go through it this way. So first question is from Jen Filson, and it looks like we've got about 5 minutes left. So I'm going to try to do this as best I can. Jen, fairy godmother of the group, thank you so much for this question. I know you sent this in ahead of time, and I appreciate you asking it here on the group. She says, here's a question about investing for retirement. If a school employee were to participate in the state pension plan or choose to do a self-directed IRA that works with JWB, which plan would likely come out ahead? To add, I sat through a Cal STRS, that's the pension plan for the state of California, I believe. And she sat through a Cal STRS seminar on it. She says she substitute taught many years ago and her pension is tiny. This webinar said that she could do a rollover in the account and the fees are low. It made her wonder if she should keep the portfolio with the existing brokers or roll it over to that retirement plan or to do a self-directed IRA. She said, I have a feeling I'm not the only one with this type of situation, so I thought I'd ask. So, there's a couple different things to go into this, right? The first thing, hey, Pablo, you're back, buddy. Maybe you can't hear us.
Yeah.
How you doing, man? Nice to see you.
I've been better, but happy to be back on the show, man. It was a dark couple minutes.
Oh, man. We were just getting into Jen's question. I know we're running out of time here, so I want to get into as many as we can. Couple things to think about, Jen. So the first thing is just like the non-recourse question that we had, right? The biggest reason why people come into investing in rental properties from their retirement accounts is for diversification, because they feel like they are weighted too heavily in stocks, bonds, mutual funds in their typical assets in their retirement accounts. And so they look for an alternative. Rental property investing creates that diversification. That's the first question I would ask for you, right? Is your retirement account weighted too heavily, in your opinion, in the traditional asset classes? Is this a win for you, even if you got the same return on investment minus all of the fees in real estate as you did in the CalSTARS investment there? That would be the first question. Most of the time, the answer is yes. And so there's value in just diversifying. The next thing is that, and Jen shared the returns on investment on this from the CalSTARS investment. And it seemed to be over the 10-year period, somewhere around maybe 8%, maybe up to 10%, which is a great return. So that is really wonderful. However, your question is, would you likely come out ahead by owning rental properties, specifically with JWB? And our track record would tell you that you would have come ahead by owning rental properties in JWB. And the reason is because if you are buying properties in your retirement account, and let's just assume that you put 50% down, what that means is that with the appreciation rate that you see, you can basically double that, and that becomes your return on investment from that home price appreciation. So I just happen to know from 2012 until present day, on average, Jacksonville's market has appreciated about 8.8% per year since 2012. And so if we think about you buying that investment property in your retirement account, and it's going to be about break even on cash flows, like we talked about. Well, if you got 9% appreciation year over year for the last 10 years, and you only put 50% down, that's like an 18% return because you only put 50% down. So probably would have a win just from diversifying, even if you were able to replicate those same 8 to 10% returns from the CalSTARS investment. But in addition to that, if you had done that 10 years ago, roughly, and invested with JWB in Jacksonville, you would have almost received twice the return on investment by owning those properties. So, and you're positioned well to do that going forward. As we know, the market is positioned on average. You see 4.3% growth year over year in Jacksonville. So that's the number I would use going forward. So it might be something similar to that, would be that 8 to 10% return. That's a conservative way of going about it. And we believe that we're positioned for a higher than normal home price appreciation over the next year. So you'd likely get a nice bump out of the gates.
I have a question, Greg. Where did your head go when I dropped off there? Did you have to scramble and pop open a bunch of windows there?
I don't know. Let's see how I did with the group. Did they feel like I was flustered there? I was a little flustered. I always get flustered when things go crazy technology wise, but I've been in the game doing this with you for like 2 years now. I feel pretty good. The community makes me feel warm and fuzzy. So I don't know. I think I did it okay.
Well, I wish that I could give you feedback, but I was clearly in the dark there for a minute. I've actually lost access to the Q&A that was out there, but I think we're right about an hour, man. So good job on the recovery. Happy to see that the show was still back on when I was gone. I know we're still live on Facebook, so that still worked. And Gina's saying she almost jumped on and put a collared shirt on.
That would be awesome.
That's really funny. Happy to see, Carlos Andres, that you enjoyed the show. We hope to have you back, man. And we hope that if you're new here, this isn't usually what happens, some weird technology glitch. That being said, next Tuesday, we got Rory Diamond on the show, who is a city councilman. He is the CEO and executive director of Canines for Warriors, an unbelievable charity here locally in town. And he's just one of the best networkers and most connected guys that is here in Jacksonville. And he's going to give us the scoop on the big decisions that are happening right now in the city council, what's coming down the pike for Jacksonville proper, from an elected official, from a resident, from somebody that, has all the information on the street that you want to know about, and what's happening in the macro economy here. I think it's going to be a really, really great conversation. If you want to go back, I think he was one of our first 8 episodes. I think he might've been episode like 5 or 6. And he was just dropping these unbelievable nuggets of how he got to Jacksonville and networked the local economy. As a networker myself, I was incredibly impressed. He's just a fun time to be around, man. You want to give us a little peek into what you're expecting with Rory?
Yeah, I just think this is an incredibly important time to speak to somebody like Rory, right? Rory is a decision maker. He is on Jacksonville City Council, which is the decision-making body for the city of Jacksonville. All big decisions go through City Council. All small decisions go through City Council. Anything that happens goes through City Council. And so Rory has one of those seats. And right now, there are so many big decisions that are happening, whether that's downtown or the investments that in the stadium where the Jaguars play. Number of really big things. We've heard a lot about what's happening with the landing. Why are more investors like JWB buying downtown buildings now? Well, a lot of that has to do with decisions that City Council has made. So we're going to review some of those decisions, and we're going to talk about what's coming next. And so I think it's really, really critical. You're seeing a lot of activity based on decisions by Rory and his colleagues there at City Council. So an incredibly important time. And then to get to know somebody like Rory, Rory is a dynamo. Rory is all about Jacksonville, all about serving the public, and is going to be here for a very long time doing very big things in Jacksonville. To get that exposure to him is really quite a treat. So super excited about it. Can't wait to have him back.
Future mayor of Jacksonville, if not governor of Florida, known with his trajectory, which is awesome. And let's not forget that Lydia Filson is up next on Thursday for the Property of the Week show. So she's going to be a hoot. Lydia is a Number one, the mother of the godmother of the Not Your Average Investor Show community. She's a renowned author. She is, what are y'all, like third or fourth generation Floridians, champion dog breeder, real estate investor. She's going to be a lot of fun to have, right? So I don't want to bury the lead there with Lydia as well, but we hope to have you back. Like we say, you came to find out about how to own rental properties in your portfolio. You were in the right place. You came to find out about best in class property management for rental property investors, how to get an edge on the Jacksonville market for a real estate professional. You're in the right place. If you like what you heard, you want a more personalized plan for you, you got some questions you want to ask the team, it's a value add. Greg, I like something that you said last week along the lines of, for all the returns and everything that we produce, one of the big values that you offer is your in-house expertise and that availability to hop on a call with that in-house expertise. So you get that by going to chatwithjwb.com. And I'm really happy that I got to come back and sign off and be a part of this. My day would have been absolutely ruined if I left the Not Your Average Investor Show, JWB Rental Property of the Week, just like that. And GC, I'll give you last word.
I can only imagine the steam that was coming out of your ears as the internet was not allowing you to get back on the show. Like to separate Pablo from a show that he's supposed to be on, I would not want to be around that.
My eyebrows almost took over my entire forehead of intensity. It was just growing in fervor. So yeah, I'm happy to be back.
Hey, just want to recognize Carlos, new first time attendee on the show. We super appreciate you being here. And he mentioned that he just put 4 houses under contract. Incredible. Thank you so much for the trust. We can't wait to be able to perform for you. And the folks that are continuing to show up, the new folks that are continuing to show up, we just appreciate you being here. We sincerely hope you come back and join in this community. We have so many amazing people here, so welcoming. And so thank you all for being here. Thank you to Carlos. Thank you for Ashmara, I believe is a new name as well.
Yeah, Ashmara.
And just wanted to recognize those new folks. We appreciate you and hope to see you every Tuesday and Thursday at this time.
All right. Adios.
See you.